Imagine if you could replace your entire investment portfolio with just one single ETF. Sounds too good to be true, right? But the reality is that for many investors, there actually is one fund that could potentially do exactly that. Welcome back to the channel. Today we're diving deep into the world of exchange-traded funds and exploring whether a single ETF could truly become your complete investment solution. First, let's talk about what makes an ETF so powerful. An exchange-traded fund is essentially a basket of investments bundled together and traded on a stock exchange just like a regular stock. What's remarkable is that you can own hundreds or even thousands of different securities with just one purchase. This is the magic of diversification wrapped up in a single ticker symbol. Now, you might be wondering which ETF could possibly replace your entire portfolio. The answer lies in something called a total market index fund. The most famous example is VTI, or the Vanguard Total Stock Market ETF. This single fund gives you exposure to the entire United States stock market in one purchase. We're talking about thousands of companies, from the largest mega-cap stocks to smaller mid-cap and small-cap companies. It's true diversification at its finest. But here's where it gets even more interesting. VTI holds approximately 3,900 companies across virtually every sector of the economy: technology, healthcare, financials, consumer goods, industrials, energy, and everything in between. This means you're not betting on any single company or even any single industry. Your investment is spread across the broadest possible base of American businesses. The beauty of owning VTI is that you're essentially buying the entire American economy. When the US economy grows, you grow with it. When it contracts, yes, you'll feel that too, but you're never overexposed to any single point of failure. The fund is weighted by market capitalization, which means larger companies have more influence on the fund's performance, but that's actually how the economy works. Yet VTI is just domestic stocks. Many investors want international exposure too. That's where VEA comes in, the Vanguard FTSE Developed Markets ETF. This fund gives you access to stocks in developed countries outside the United States. We're talking about Europe, Japan, Australia, and other economically advanced nations. Between VTI and VEA, you could own a significant portion of the global developed economy. But what about emerging markets? What about bonds? What about real estate? These are legitimate questions that many investors ask. The truth is that you could theoretically build an entire globally diversified portfolio using just 3 ETFs: VTI for US stocks, VEA for developed international stocks, and VXUS for emerging markets. Add in a bond ETF like BND, and you've got a complete portfolio. However, there's one ETF that deserves special attention. It's called VGRO, or the Vanguard Growth ETF Portfolio. This is a fund that holds a mix of stocks and bonds, automatically balanced for growth-oriented investors. But more importantly, there's another option called VTSAX. Wait, that's a mutual fund, not an ETF. Let me correct that. We're talking about VYM, the Vanguard High Dividend Yield ETF, or better yet, VGTSX as a mutual fund equivalent. Actually, the single ETF that could most closely replace your entire portfolio is something even more elegant. It's called VGRO for the portfolio version. But the true all-in-one solution is represented by funds like ITOT, the iShares Core S&P Total US Stock Market ETF, or even better, VFIAX combined with international exposure. But if we're being honest about one single ETF that could replace everything, we need to talk about the reality. That reality is that no single US-only ETF can truly replace an entire portfolio if you want bonds, international exposure, and real estate. However, there are global all-asset ETFs emerging. The Vanguard Asset Allocation ETFs like VGRO for Growth offer exactly this. One fund holds stocks and bonds across domestic and international markets. You buy it, you hold it, you let it do its job. The power of this approach is almost unbelievable when you think about it. Instead of managing dozens of positions, reading quarterly reports, timing the market, or trying to pick winning stocks, you simply own the entire market. Your returns will match the market returns. You won't beat the market, but you won't underperform it either, minus a tiny expense ratio. Let's talk about the numbers for a moment. The average professional investor underperforms the market. This is documented fact. Studies show that 80 to 85% of professional money managers fail to beat a simple index fund over a 10-year period. If the experts can't beat it, How can you? This is why owning the market through a single ETF is actually a winning strategy. Consider the psychological benefits as well. With one ETF, you eliminate analysis paralysis. You don't spend hours researching individual stocks. You don't lose sleep over holdings that are down 20%. You don't chase performance by selling winners and buying losers at the wrong time. You simply invest, remain calm, and let compound growth do its work over decades. The cost structure of these ETFs is also revolutionary compared to traditional investing. A total market ETF charges perhaps 3 to 4 basis points annually. That means on a $100,000 portfolio, you're paying $30 to $40 per year. Compare that to the 1 to 2% annual fees that many traditional financial advisors charge, and you're looking at savings of $1,000 to $2,000 every single year on that same portfolio. Over 30 years, these fee savings compound into hundreds of thousands of dollars. It's not just about what you earn, it's about what you don't lose to fees. Every dollar saved on fees is a dollar that continues to compound and grow. This is one of the most underrated advantages of simple, low-cost ETF investing. Now let's address the elephant in the room. Isn't owning the entire market boring? Won't you underperform? The answer to the first question is yes, and the answer to the second question is also yes, but in a good way. You will underperform the best performing stocks in any given year. You'll also outperform the worst performing stocks. Over time, this averaging out is called regression to the mean, and it works in your favor. Think about it this way. In any given year, maybe 1 or 2 stocks return 500%, but they're exceptions. Most stocks return something in between 0 and 20%. By owning thousands of them, you capture that average upside without the risk of picking the wrong ones. This is the core philosophy of index investing, and it's been proven to work over and over again through decades of market history. The tax efficiency of ETFs is another massive advantage. Because ETFs use an in-kind creation and redemption process, they rarely distribute capital gains to shareholders. This means you're not forced to pay taxes on gains you didn't trigger. You only pay taxes when you decide to sell, and those taxes are long-term capital gains rates if you've held longer than a year. Mutual funds, by contrast, often distribute capital gains annually, forcing you to pay taxes on gains immediately. Let's talk about the behavioral finance aspect. Most investors would be better off doing nothing. Seriously, the biggest mistakes people make are buying high when they're excited and selling low when they're scared. With a single ETF strategy, the only decision you need to make is whether to buy more during downturns or stay the course. Both are actually correct answers. Dollar cost averaging by investing the same amount every month removes the temptation to time the market. Imagine you invested $10,000 monthly into VTI starting in January 2008, right before the financial crisis. Even though you bought at the worst possible time in recent history, you would have made millions of dollars by today, simply because you kept buying through the crash. Your average cost would have been lower because you bought more shares when prices were depressed. This is the power of time and consistent investing. The simplicity of this strategy also means it's sustainable. You're not going to burn out. You're not going to wake up one day and decide you're tired of managing 50 different positions. You're not going to make an emotional decision to sell everything because the news scared you. The single ETF strategy is so straightforward that you can stick with it for 50 years without breaking a sweat. Some people argue that you need bonds in your portfolio to reduce volatility. This is true. Pure stock portfolios do swing more than mixed portfolios. But here's the thing. If you have a long time horizon, you don't need bonds. Stocks have never lost money over any 30-year period in American history. Never. Not once. So if you won't need the money for 30 years, a 100% stock portfolio makes mathematical sense. For those who do want bond exposure or who are near retirement, the solution is simple. Instead of VTI alone, you buy VTI and BND in whatever ratio makes sense for your situation. Maybe it's 70% VTI and 30% BND. Maybe it's 80-20. The exact ratio depends on your age, risk tolerance, and timeline, but the concept remains the same. You're building a complete portfolio with just 2 or 3 funds. The global aspect of modern ETFs also shouldn't be overlooked. Some of the biggest companies in VTI generate revenue internationally. Apple, Microsoft, and Coca-Cola all earn substantial portions of their revenue abroad. So even if you own VTI alone, you're getting some international exposure through these multinational corporations. That said, Emerging markets like India and China are growing faster than developed markets, so some international stock exposure makes sense for long-term investors. Let's talk about rebalancing, because this is where the magic really happens. If you own VTI and BND in an 80-20 ratio, and the stock market has a fantastic year while bonds lag, your allocation might drift to 85-15 or 90-10. The simple solution is to buy more bonds until you're back to 80-20. This forces you to sell high in stocks and buy low in bonds. It's the opposite of what most people do, and it actually works. Many investors actually overcomplicate their portfolios. They own individual stocks alongside their index funds. They try to pick winners. They chase performance. They follow the stock tips from talking heads on financial television. These actions almost universally hurt performance. The data is clear. A simple, boring, diversified ETF strategy outperforms complicated strategies more often than not. There's also the concept of lifestyle creep and investment returns. If you invest in a simple ETF portfolio early in your career and let it compound for decades, you might not need to work as many years as you think. Some people who started investing at 25 with regular contributions to index funds found themselves financially independent by 45. They weren't making $100,000 a year. They simply invested consistently, spent less than they earned, and let compound growth do the heavy lifting. The mental health benefits of this approach are real too. You're not constantly checking your portfolio, you're not losing sleep over daily fluctuations, you're not arguing with yourself about whether to buy or sell.